With markets down and the end of the year approaching, you may be wondering whether we've got any other tax reduction ideas up our sleeves. You bet we do. Today, the RLS boys dig in to the ins and outs of tax loss harvesting, the process of reaping unrealized losses in taxable accounts to offset current or future capital gains, and thereby keeping the IRS at bay for a little while longer. But is it for you? Maybe in your situation, the better play would be tax gain harvesting. Who knows? Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Eric Olson and Adrian Nicholson, back with a great episode for you today. We're going to be talking about a fairly complex topic today of tax loss harvesting, And as we approached this, we thought the numbers were a little simple and basic. And then as we got deeper and deeper into it, we realized how complicated it was. So we're hoping you'll find this episode very helpful for those of you listening to help manage and minimize your tax liabilities. Adrian, I'll pass it on to you to start us off.
Yeah, thanks, Roshan. I appreciate that. And like you touched on, this is a very complex topic that we're going to be discussing today. And we just want to present to you really good tax strategies. This isn't tax advice. We don't know your circumstance and we don't want to give you just general advice, but we want to give you ideas for you to consider, really look into where you can really save the most on taxes whenever you have that opportunity. So if you have any questions, we're always happy to help. But also, if you can, seek out a tax professional as well if you want to really dive into it deeper. So we just want to give you things to really go over and strategies that can help out your situation the best way you can.
You're here.
Yeah.
So,
Just starting us off, Adrian, why don't you take us into what tax loss harvesting is?
Yeah, this is a really good strategy that people can use where they have certain investments that they own. And at a particular point, you might consider whether you should be holding on to these investments or selling them. And one thing that you really should look at as well are what are going to be the tax implications. So when you sell a position, you'll have to pay tax on it, especially if this is a non-qualified account. They are treated differently, whether it's an IRA, a Roth IRA, or 401k, you might not have to worry about it. But when it comes to non-qualified account, like a regular brokerage account, once you sell the position, there are tax consequences. So when we talk about tax loss harvesting, this is a strategy where you can offset a sale in order to reduce your tax bill. So again, if this is a non-qualified account, this is something you have to be aware of. If this is an IRA or Roth IRA, this is something you really don't have to consider. And also a big part of this as well is what tax bracket you're in. That's going to be extremely important. So like I said in the beginning of the podcast, that's something you have to really be aware of, especially on an individual level, is how much are you going to pay in taxes this year? What is your income going to be? Because that's going to be a very big driving point with this strategy that we're going to go over today.
Yes, indeed. So you want to talk about at a high level, Roshan, just the benefit in trying to quantify that, and then I can maybe get a little deeper into some of those numbers.
Yeah. So, and Eric will review this in depth, but we're going to review a white paper today, and then where they talk about the improvement to your portfolio, and it says it can increase your overall performance to about a 1% increase per year by taking these tax losses. Now, going further into that, if you think about it, what you're doing is you can claim up to $3,000 of a loss on your tax return, offsetting your ordinary income. So you get a deduction there, and you can also look at capital gains, the savings you'd have there if you're offsetting. You're selling something that's made money, offsetting it with something that's lost money. saving you the capital gains tax on the profitable investment, the higher your income, the bigger impact this will have. So if you're looking at from a capital gains perspective, if your income is single under 41,000 for 2022, 41,675, or married under 83,350 for 2022, well, then you don't actually pay capital gains. You're at a zero capital gains tax rate. So for you, it still might be worth listening to this if you're expecting your income to go up along the way. If you're not, then you're at zero capital gains rate. A lot of what we're going to talk about won't apply. Now, if you're at the next level up, from if you're single 41,675 to 45,750, we'll include this information in the show notes. By the way, you don't need to write it down. Or between 83,350 and 517 for married, you're in the 15% capital gains rates. So if you manage this well, you might be able to save that 15%, which can compound over time. Finally, if you're above those top levels, 459, 750 for single, or 517, 200 for married filing joint, that's a 20% capital gains rate. So an even bigger impact on your portfolio. So all that being said, something you probably knew, the more money you have, the higher the income, the higher capital gains rates, the more valuable these tax managing strategies are.
Here, here. So let's talk about some of the specifics on the benefits, and just put this in some kind of context. Remember, as Adrian said, this doesn't apply to IRAs or Roth IRAs or 401ks. This is strictly in an account where it's taxable. But you can use the advantages of harvesting losses in these accounts to offset not only the gains in these same accounts. You can also use these to offset gains that you might have had from selling some real estate or something of that nature. So you're looking across your entire tax year, all of the gains that you have had already that have gone, that you've actually booked so far, or you expect you will before the end of the year, then finding losses to offset those can be a big help, especially if the way in which you do that is offsetting things that are they're going to be taxed as ordinary income at the higher ordinary income tax rate. Let me just actually explain that concept, because some listeners may be saying, what's this difference between ordinary and capital gains tax rates, long-term capital gains?
Before you jump into that, I think it's a great time to say these are strategies. Please consult your advisor, consult your tax professional, your CPA as well. As we go further down this rabbit hole, the complexity just increases, and it, in my mind, shows you how important those professionals are even more so.
and nevertheless, I'm going to continue to harbor the naive hope that we can explain it in such a way that every listener is going to be saying, "Oh, I totally understand that." So
yeah, I think a lot of people will hit the stop play button and forward this to their accountant right now.
Okay, well, maybe so. So when we have two types of tax rates at the federal level, in the main. One is when you go to work and you earn a salary, or if you have interest on a checking account or income from a bond portfolio or something like that, or if you sell a position that you had invested in a shorter period than 1 year's time. All of that is treated as quote unquote ordinary income. And in that case, or at least it's taxed at an ordinary income tax rate, which is higher. So those rates currently are 0, 12, 22, 24, 32, and 35 and 37. Incidentally, in 2026, those are going to go back up a bit. But the capital gains tax rate is reserved for those things that you bought, held for at least a year, and then sold at a gain. And those tax rates are gentler. So if your ordinary income tax rate was in one of those two lowest brackets, well, actually 0 or 10, or actually the three lowest, 0, 10, or 12, then good news. Your long-term capital gains are taxed at 0. You should smile. You should turn off this podcast almost now, because the long-term capital gains that you could harvest the losses that you could harvest are not going to do you any good. In fact, you might even think about doing just the opposite, harvesting your gains while you can at 0%, and getting those things booked and resetting your cost basis at a higher level. But if you're in a higher bracket than 0 or 10 or no, 0, 10, or 12, then if you're at a higher bracket than that, 22 or higher, you're at a 15% long-term capital gains tax rate. Or if you get way into the higher brackets, that'll go to 20. And oh my goodness, if you're making a lot of money and having a lot of investment income, then they're gonna hit you one more time with another 3.8% surcharge. It's going to go to 23.8. So there's reason, especially in the higher rates, to be thinking, how do I avoid this? So Roshan said earlier that the benefit of this process was measured in this paper that we'll link to, and which will you can go find this for yourself. But in this paper published in 2020 by a number of academics, that what they found was that looking from 1926 to 2018, if you followed this process religiously, you would have had, before some adjustments I'll explain in just a moment, a 1.08% additional return to your portfolio. That's not trivial, especially if you allow that to compound over time. So what in that case were some of the influences that could change that? Well, one was that in different periods, the returns were higher or lower than that. And generally speaking, the more volatile the period and the less the more the markets moved sideways or down than they moved up, during those phases, the benefit was greater. Whereas conversely, if markets were not very volatile and steadily moving up, then it was less good. They also found that it made a difference if you were contributing to your portfolio on a regular basis, holding steady with your portfolio, or actually withdrawing from your portfolio on a regular basis.
Before you move on to that second point, on that first point, I think it's just important to sort of state the obvious here. You don't know what phase you're in, right?
That's true.
When you're dealing with it. So I think you've got to take the approach of reviewing your portfolio and seeing if there are opportunities there, because there is definitely a difference between what phase, but you're not able to see it till after the fact.
Well, that's a good point. So let me pause there in response to what you just said, Roshan. So 2022 has been a year in which we're mostly sitting at the end of the year at a lower point in many of the holdings that we have than we started the year. So for many people, this would be an example of one of those instances where you want to look closely at this, because you may have a considerable number of losses or unrealized losses. I'll say that, unrealized losses, meaning you haven't closed the deal yet, you haven't sold it, so it's still a paper loss. But if you have a paper loss on some of these things, this might be the time to really look more closely, and hence why we're addressing this topic this year, whereas we haven't done so in previous years where it's been mostly up. But coming back to this,
hold on, I got to add something else there,
sure.
Eric. That being said, up and down year, Adrian and Eric, tell me if I'm wrong, but you do review this every year, regardless of what the market's done, for clients with non-qualified accounts, correct?
I do, but I don't.
I do as well.
I'll say I'm glad to hear that, and because there are individual circumstances and there are individual holdings, and we're always trying to find an edge for our clients. But if I looked yesterday at the spreadsheet that I did at the end of 2021 for clients, and what I found mostly was a lot of unrealized gains more than I found unrealized losses. And so we had to kind of get down deep into the weeds and say, it's not the 1,000 shares of XYZ that collectively have this minor loss potentially. Instead, I can look at all the individual purchases of XYZ, that, the 25 shares here and the 50 shares there, and find which of that 1,000 shares of XYZ had been purchased at prices above where we were. Then we could selectively sell those shares with the highest initial price and book the loss on those but leave the gains and the other underlying shares of XYZ untouched. Did you do that?
Yes, we do look deeper into the specific tax lots as well along the way.
Mm-hmm.
Yeah. My point was just that yes, there are more opportunities to do this in this year in a down
Mm-hmm.
year, but regardless of what action steps you take, I think it's worth reviewing the portfolio for this annual.
Mm-hmm. Good point.
Right.
And I think
Yeah.
we were doing this we didn't have this podcast in 2018, but at the end of 2018, when you might remember October, November, and December, right into Christmas Eve, was that was a really swift and unexpected downturn. So that as well provided another good opportunity to look at this. And if you think about it, it's not necessarily a strategy that has to be left till the end of the year. If you could know, for example, in early 2020, when COVID hit hard, we dropped 35% faster in the US and the S&P 500 than we'd ever dropped before. If you had known at that point that there would be a pretty swift rebound and that you wouldn't see those lows again anytime soon, you probably would have used that window to take those losses. I think in my case, just confessing what my outlook was, I thought, on the one hand, I think it very well could go higher. I think this is a shock and there will be a recovery. But I also thought there's a possibility that it could continue lower and I might regret getting to it too soon.
Yeah, and I remember thinking very much at that time that, and the reading a lot of the financial press out there saying, "Oh, there's another leg down,"
Mm-hmm.
which didn't actually happen.
Mm-hmm.
So yeah, that part also of being trying to predict where the market's going to head with these tax loss harvesting, I think that definitely makes it a little bit harder. But once again, reviewing this or keeping this in the back of your mind throughout the year, reviewing it annually or keeping it in the back of your mind, I think is a wise move.
Mm-hmm.
I always look at things like this and say, if you decide not to do anything, make it a conscious decision.
Mm-hmm.
Don't just make it that, hey, I forgot to look this year.
Mm-hmm. Good point. Well, let me wrap up on the benefits just quick. So I had said that there's a difference in the benefit to the person who's putting money in. Actually, to that person, the benefit is greater. There's less of a benefit to the person who's taking out. And so that's a consideration as well. And then if you're in a lower marginal income tax bracket, but still, let's say in a 15% capital gains tax rate, the difference between your ordinary income tax rate and the capital gains tax rate is part of what makes this strategy so rewarding. Let's just do the subtraction. Let's all go back to first grade. If you take 35% and you subtract 15%, the difference is 20%. But if, on the other hand, you're at a 22% rate for your ordinary income tax and still at a 15% rate for your long-term capital gains tax rate, now that difference, 22% minus 15%, is only 7%. So as a result, the tax rate arbitrage across those two rates is not as great. Now, you might be thinking, Eric, what are you talking about, tax rate arbitrage? So let's just explain the mechanics again, and then we're going to get to some wisdom about the people for whom this makes more sense and then the people for whom this makes less sense. So here's the mechanics. Let's pretend again, apparently I love stock XYZ. I hope there isn't an actual stock out there that's XYZ, because then everybody's going to think I'm touting it. This is just a made up company XYZ. And let's say I spent $100,000 to buy the stock of company XYZ one time. Then, oh, doggone it, the market turns down and I am sitting on a paper loss of 30% in that holding. It's down to a value of $70,000 on paper. I have a choice. I can say, I'm just going to hold it and wait till it comes back. Or I could sell the position and book that $30,000 loss, turn it, in other words, from a paper loss to a real loss, and then be able to tell the IRS, hey, look, I had $30,000 in losses. I'm going to use this to offset other gains that I have this year. Or I may carry it over and use it next year. And as Roshan pointed out earlier, you do get to use, and if there's still $3,000 of losses sitting around that you can't use that year, the first 3,000 of those losses you don't have to carry over to the future year. You can just put those on your tax return and say minus 3,000 from your income, and you'll pay less tax then as a result of reporting $3,000 less taxable income. But here's the point. Let's say then XYZ comes back. We would expect XYZ would come back. I can repurchase, and I'm going to put an asterisk by that because I have to explain when, but I can repurchase XYZ. And let's say I repurchase it at the $70,000 and it comes back to $100,000 again. Well, in the first case, when I bank the loss, I get to use that as a loss of some kind, possibly against my short-term rates. But when it comes back, provided I hold it for more than a year, I get to pay taxes on it as if it was only at my lower rate of long-term capital gains. In other words, get the benefit of a tax subtraction at the high rate, accept the disadvantage of the tax on but at a lower rate, I get to book the difference. That's the magic. And so the larger the difference, the more useful that is. Now, last point, I put an asterisk on there. There's an element of this story that you should know. It's called the wash sale rule. Don't ask me to explain the terminology. It's basically, it's meant to avoid too much of this sell today to book the loss and buy it right back tomorrow and just be playing a tax game. The IRS says, no, we know what you're doing there. We know exactly what you're doing there. And we're not going to let you book that loss. We're going to treat it as if you still own that from your original $100,000 cost. So what do? We have two choices. Well, three choices. One, don't sell it. Choice number two, sell it and sit in cash for 31 days, then repurchase it. That has some downsides. Actually has the downside of that is not trivial either. It could be, another 20.2% that you're forfeiting in that case. So here's the third thing you can do. Buy something that's similar, but not too similar. In other words, if let's say you were invested in something that was a large cap, let's say just use a large cap index fund, maybe buy a mid cap index fund for a while and hold on to that for a period of time. Or if you were in a large cap growth index fund or large cap growth index fund of some kind, buy a large cap value index fund or something of that nature, something that you could defend to the IRS is different enough that it isn't just a superficial replacement of something that for all intents and purposes is identical. Now here's this.
Yeah,
go ahead.
IRS, they use a term called substantially identical.
Mm-hmm.
That's the IRS term. So you can't sell. So for example, you can't sell the Vanguard S&P 500 and then go buy the iShares S&P 500. Right. That's
perfect.
Basically the same thing for the IRS. But Eric, as you were saying, it's got to be sufficiently different. And the IRS has not defined that clearly. So theoretically, with that example I gave, it may work if you sold the S&P 500 index and then bought the Russell 1000 index.
Mm-hmm.
Both are for larger U.S. companies. It's a different index. That's an example I've seen online as a sufficient, different enough, substantial that it doesn't qualify under the substantially identical rule that it could work.
Mm-hmm.
So that's just going further. The IRS, it's not clearly defined, but you've got to be smart about it.
Yes.
Mm-hmm. Yeah, it's a good idea that you brought up, Eric, too, because it's also a way where you can use this tax loss harvesting strategy to rebalance or just diversify yourself as well, where if you have maybe too much exposure in one area and you've been looking at that, you can use this tax loss strategy to save on taxes, diversify yourself more, and maybe cut back some of your exposure to help balance your risk and reward adjustment for your portfolio. So that's another good benefit that people
that's
should
an
be
excellent
aware
point. Absolutely. Coordinating this decision along with your other decisions about overall portfolio management is absolutely a genius way to proceed. So I was talking about the wash sale rule, and it's really a challenge here to see if I can make something so tedious sound actually interesting and exciting. But I do have to mention one more thing about the wash sale rule, because you might say, "Oh, okay, well, I just figured out what Roshan said. I'll go ahead and sell my S&P 500 and replace it with a Russell 1000." Not so fast. Not so fast. Because what the IRS can look at, I don't know, they will always look at, but they will look at not just that same one account where you did that tax loss harvesting. They can look at your IRAs, your Roth IRAs, your 401ks, your spouse's IRAs, Roth IRAs, and 401ks. They can look at the entire household to see if you were doing a little bit of gamesmanship there, selling XYZ one day, and then in one account, and then going right out into one of those other accounts, trying to see if you can be sneaky and get away with it and buy it right back. You cannot do that. So just be aware that this wash sale rule is designed. You'll just basically, if they catch you, and we hope they will, because we'd want the IRS to be good at their jobs. But if they catch you, then you will have defeated yourself in this effort to harvest this tax loss.
That's a very good point. You can't sell it in one account and buy the exact same thing in another account.
Here. So,
yeah, something that I looked that it might be interesting or people should really look at too is, I know in particular some people have 401ks and they have vested shares as well. Can't they run into some issues with the wash sale if they sell that and then the vesting cycle happens and then they get these shares? Wouldn't that trigger the IRS and make it a wash sale rule? I think that's something people should
question,
really look
Adrian.
at.
I don't know the answer to that. Now I kind of wish I had a CPA. Then I would be able. No, that's a great question. Hadn't even thought about that.
Because it would be in the instance where you sell this stock that you own, and then let's just say 5 days later the month ends, and then your vesting shares are up and you get them. That could be something that triggers it. So it's just something maybe to look into.
All right.
Actually, Adrian, that is something that triggers it. I have had a scenario where a client had shares assigned via options. So they had covered calls, they had the shares assigned, and they had shares come in that vested, and that violated the wash sale rule.
Oh, I did not know that.
Darn.
Yes.
That's rough. And the IRS knocked down their door. And then they were just so mad at
Well,
them.
fortunately, the 1099 form that was provided to them caught all of it, so they didn't have to deal with the IRS knocking down their door. But there was a wash sale on their paperwork for that reason.
Terrible. Well, let's talk, gentlemen. Let's give our listener some wisdom about whether or not this makes sense for them, or in which instances this might make more sense. How about it?
Yes.
All right. So I think some of what we've said will make a couple of these points fairly obvious for you, listener, but just let's outline some of these anyway. So number one, if you're in a situation where you don't expect to have any capital gains this year, then there's no urgency, at least, to harvesting the losses. They're not.
Well, actually, Eric, though, if you don't have any capital gains this year, once again, it makes it worth looking at, because then you may be able to claim a capital loss to save some money in taxes.
Right. My second sentence. So yes, you might take 3,000 off the table so that you take the 3,000 of those losses against your ordinary income, and you can do that. But I would also say that this down years are a good year to find, or at least it's easier to find losses. And you might want to book some losses and just stick those in your capital loss piggy bank and just have those waiting until such a time as you do have some gains. Then you can draw these out of the piggy bank, throw them down on the table right next to those gains that you eventually harvest, or those gains, the gains that you eventually harvest as well. And now they'll offset each other. And as a result, you will be able to receive those gains in the future at a zero tax implication, or at least a lower tax implication. But anyway, that's it. In other words, let's state it in the reverse. If you do have realized gains so far this year, or you anticipate realizing some gains this year, this is a good year in which to look for some losses to offset that. That's especially true if you have short-term capital gains, because those are the ones that are going to be taxed at your higher rate, your ordinary income tax rate, and not your long-term capital gains tax rate. And all the more reason to want to offset those. We also said if you're in a higher marginal income tax bracket, well, it makes more sense for you than if, especially if you said, you might say, well, Eric, I'm not in an extremely high marginal income tax bracket. Well, what about this? Are you in a higher marginal income tax bracket today than you might be a few years out and if you could wait to liquidate these positions that have some of these gains until later, you might at that point be able to perhaps be in that zero long-term capital gains tax rate. And so if given the option, you might say, why would I want to bank losses now to use against what I would pay zero on in the future anyway? So it's a timing issue if you're coming up on a downshift in your marginal bracket and hence into a 0% capital gains tax bracket. Next, if you have a really long time horizon before you're going to liquidate that portfolio, that might be an additional motivation to do some tax loss harvesting. You might be saying, well, why is that? Because then the longer that position that you would repurchase or that you would substitute in will have a chance to develop over time and to grow and build, the more getting that loss book now and used to get other tax obligations out of the way, the more that can help you. You're just deferring taxes out farther and farther and farther into the future. And one of the side benefits of this approach is tax deferral, even if it's not always tax reduction. Here's another reason you might want to do it. Let's say that you're anticipating that you're going to donate your highly appreciated stock into a donor advised fund, or you're going to donate it directly to some charitable organization. Since by doing so, you won't incur that capital gains tax at that point in time. That makes sense to book some losses now and use it against other short-term gains that you might have had, and allow then that position that you repurchase at a new lower rate. Remember, at 70,000 on XYZ, not at 100,000 that you formerly owned it at. That additional $30,000 of gain for you, since you give it away, won't be taxed. That's the same as being taxed at zero. So you just made that tax rate arbitrage play even wider than it otherwise would have been. Finally, if you have no unused losses that you carried over from previous years, you might just want to replenish the piggy bank. Gentlemen, in terms of, I've got some things to say as well about circumstances in which you may say it's less useful to do this, but do you have any other comments or ideas about circumstances in which it's more useful?
No, I like what you just shared with the tax rate arbitrage. And the other thing I'd point out is, because you don't know where you're going to be in the future, I think you've got to make a good sort of guess at that. And, will I be at a lower bracket, higher bracket, just looking at where you are in your stage of life? Are you in the higher earning years? Is retirement a year or two away? And use that to help you make those decisions.
Mm-hmm. Yeah, absolutely. Actually, I guess I would have one corrective to what I said about if you're moving into a zero capital gains tax bracket in a couple of years, coming back to the XYZ example, you might actually there say, yeah, let's go ahead and book that $30,000 of losses, because as it recovers in 2 years or 3 years, as long as it's a year and a day, if I then harvest it and I'm in, or then I then sell that position, realize the additional gain from purchasing at 70, not at 100, that will be taxed at zero. That could actually be a rationale for doing that move. But what about some instances in which it's not such a great decision for you? If you're, number one, we said this already, if you're in a 0% long-term capital gains tax rate right now, I don't see a lot of benefit to you to doing some of this unless you have some short-term capital gains that you've booked, but certainly not if you're in a long-term capital gains tax rate of zero. It seems like that's less useful to you. Would you agree with that, gentlemen?
Yes.
All right.
Yes.
And then another circumstance might be that if you're going to be when you finally liquidate that XYZ, remember it was 100, you realize that you booked the loss, you repurchased at 70 or something like it recovers. If at some point then when it recovers, you'll be in a higher long-term capital gains tax bracket, that maybe won't work to your advantage that way. Or if you were going to liquidate that position that you repurchased while it's still short term, but next year you were going to be in a higher ordinary income tax bracket, there again, why would you, for example, book a loss against a 22% rate this year if next year you were going to be paying a 32% on the recovered short term, the recovery, and then pay taxes short term on 32%? That makes no sense. And if one other thing is just to recap that, if there was a strong motivation for you to liquidate some portion of this portfolio next year, within less than 12 months, then right there, you will also have this issue of anything being short term. And so there's really not that tax rate arbitrage opportunity again. Gentlemen, I think we could go on with sort of tips and refinements of all of this for a long, long time. But I think, in my sense at least, is that we've covered the essence of what this process looks like and how to have some nuanced understanding of when it might be useful and when it might not be. As we've said throughout this episode, this is not something where you just go, oh, okay, Roshan, Adrian, and Eric were telling me to go do this. No, please go talk with your tax advisor. And if you're thinking, before I talk with my tax advisor, I just need you to explain it to me a little bit more clearly. I've listened to the episode 3 times already and it's still not registering. Our contact information is in the show notes. Go to retirementlifestyleshow.com. Look in the show notes. You'll find our contact information. You'll find it also at the bottom of our homepage. Reach out to us and we'll be happy to have a conversation with you.
Yep, we're definitely there to help. Now, changing topics for a second, gentlemen. Happy Thanksgiving.
Mm-hmm.
We're recording this the day before.
Happy Thanksgiving.
Yeah. What are your plans for Thanksgiving, Eric?
We were going to have a larger gathering of some international students that we've gotten to know, actually some refugees from Afghanistan, and then that plan fell apart. So I think tomorrow morning we're heading off to church, and then we're going to head over and do some serving for some homeless people, and then we're coming back and we're going to have a meal together. How about you?
That's wonderful. That's great. God, a great way to
Nice.
give back. A great use of your time and your day. We've got family coming over Thursday, and I think this is the 4th year that I'll be frying a turkey, and so I'll be doing that Thursday, and then doing it again Saturday, Friday at my house, Saturday at my in-laws' place.
How fun.
Adrian, how about you?
Family, just going to see a lot of my family, probably watch a lot of sports, just hang out, just enjoying the day with the family. Just keeping it simple this year.
Oh, that's great.
Awesome.
That's what Thanksgiving's all about. Well, gentlemen, happy Thanksgiving to both of you, to all of our listeners. We hope you have a great Thanksgiving. This will actually air after Thanksgiving, so we hope you had a wonderful and a great Thanksgiving. We'll be back next week with another great action-packed episode. Please like, subscribe, give us 5 stars, tell your friends and family. This has been the Retirement Lifestyle Show.